Building up a Forex trading system helps you to take a more target way to deal with your trading. In the short term, you're trading on the premise of tried strategies as opposed to individual hunches. In the long run, you are putting your individual trading inside of the most extensive setting of your principles for cash administration. The foreign trade, or Forex, market exists to permit the worldwide exchanging of global monetary forms. By accumulating purchasers and traders, the business sector builds up the relative estimation of every currency against a scope of different monetary standards. Currency transformation is vital to encourage international trading. However, the Forex market additionally empowers direct theory on the relative estimation of individual monetary standards. That is, it permits dealers to purchase and offer particular monetary standards with a perspective introduced to make benefit only. At the point when a currency is worthy in the Forex market, it is usually exchanging at a high exchange rate against different monetary forms, and its cost is for the most part rising. At the point when the currency is powerless in the business sector, it is for the most part being exchanged at a low exchange rate against monetary standards, and its cost is generally falling. The currency is the biggest budgetary business sector on the planet. The liquidity that originates from a business sector that trades almost $2 trillion consistently, empowering you as a financial specialist to enter and leave your positions effectively without worrying about the value hopping too far before you execute your exchange. Having a business sector of this size likewise makes it substantially more troublesome for any particular group to come in and attempt to control the business sector. An introduction to Forex trading. What is Forex? Forex, or FX, is short for foreign exchange market. But what is a Forex market? Foreign exchanges market, that place where the trading of currencies is being done. Many people believe that currency is not important for them, but the fact is that at some point or another it has been utilized by each and every one of us. People need currency in order to conduct foreign trade and business. For example, you are living in the United States and want to purchase cheese from France. You'd definitely be paying for the import you are going to make, and you'll be paying in euros, which means that you will have to get the US dollars exchanged for euros from the Forex market. Similar is the case with traveling. A French guy visiting Egypt on a holiday would take along the Egyptian pounds in exchange for French euros, since euros are not the local currency being used in Egypt. The major reason behind Forex market being the largest one is the need for everyone to exchange currencies. It is the most liquid financial market in the world that it dwarfs other markets in size, even the stock market. One of a unique part of this universal business sector is that there is no focal commercial center for external trade, or maybe cash exchanging is led electronically over the counter, OTC, which implies that all exchanges happen by means of computer system between traders all around the world, instead of on one centralized exchange. The business sector is open 24 hours a day, 5.5 days a week, and financial standards are exchanged worldwide in the major budgetary focuses of London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris and Sydney, crosswise oververging on each time zone. This implies when the exchanging day in the US closes, the Forex market starts once again in Tokyo and Hong Kong. Considering all things, the Forex business sector can be to a great degree dynamic at whatever time of the day, with price quotes evolving continually. Why is Forex market important? The Forex market is the foundation of universal exchange and worldwide contribution. It is fundamental to boost imports and fares, which are important to access assets and to make extra interest for products and administrations. Without the capacity to exchange diverse monetary standards, organizations' prospects would be restricted and worldwide financial development would endure. Financial specialists additionally utilize the Forex market. The individuals who look for universal enhancement advantages need to exchange monetary standards to purchase and offer foreign resources and securities. A few speculators view monetary standards as a benefits class and exchange coinage to create alpha. Since now you know what is Forex market, it will now be easy for you to understand what Forex trading is. Defining Forex trading. The exchange of currencies between two or more countries on a recognized market. Forex trading is a popular type of investing because it provides investors with the ability to make quick profits due to small changes in one country's currency. Due to the time differences around the world, Forex trading takes place continuously because, as one market closes, another one opens. History of Forex. Given the universal nature of the Forex exchange market, it is vital to first scrutinize and learn some of the significant historical events relating to currencies and currency exchange before stepping into any trades. This chapter will review the international financial system and how it has progressed to its existing state. Next, in this chapter, you will come across the major players that occupy the Forex market, something that is vital for all future Forex traders to understand. Gold Standard System. The gold standard monetary system was introduced in 1875, marking one of the most important events in the history of the Forex market. Before implementation of the gold standard system, countries would make use of gold and silver for international payments. The issues which arose because of usage of gold and silver as means of payment was that its value was affected by the supply and demand. For example, if a new gold mine was discovered, it would lower the gold price. The basic idea behind introducing gold standard system was that the governments assured the exchange of currency into a particular amount of gold and vice versa. In simple words, a currency would be backed up by gold. Evidently, governments needed a monetarily considerable gold reserve in order to meet the requirement for currency exchanges. During the late 19th century, all of the chief economic countries had defined a sum of currency to an ounce of gold. With the passage of time, the variation in the price of an ounce of gold between two currencies became the exchange rate for those two currencies. This symbolized the first standardized means of currency exchange in the past. With the commencement of World War I, the gold standard eventually broke down. Due to the political strain with Germany, the most important European powers felt to call for to complete huge military projects. The financial load of these tasks was so extensive that there was not enough gold at the time to swap over for all the surplus currency that the governments were printing off. Although the gold standard would make a small revisiting during the interwar years, most countries dropped it again by the onset of World War II. Despite this, the gold never lost its value in being the eventual form of monetary value. Bretton Woods System. Prior to the end of World War II, the Allied countries trusted that there would be a need to set up a financial framework in order to fill the void that was empty when the gold standard system was relinquished. In July 1944, more than 700 delegates from the Allies assembled at Bretton Woods, New Hampshire, to consider what might be known as the Bretton Woods Arrangement of Universal Money-Related Administration. To rearrange, Bretton Woods prompted the development of the accompanying. First, a strategy for altered trade rates. Second, the US dollar supplanting the gold standard system to end up an essential store money. And third, the formation of 3 worldwide offices to administer financial movement: the International Monetary Fund, IMF, International Bank for Reconstruction and Development, and the General Agreement on Tariffs and Trade, GATT. One of the principal elements of Bretton Woods is that the US dollar replacing gold as the primary standard of convertibility for the world's monetary forms, and moreover, the US dollar turned into the main coin that would be supported by gold. This ended up being the essential reason that Bretton Woods, in the long run, failed. Throughout the following 25 or so years, the US needed to run a progression of the balance of installment efficiencies with a specific end goal to be the world's reserved currency. By the mid-1970s, US gold stores were depleted to the point that the US Treasury did not have enough gold to cover all the US dollars that foreign national banks had kept in reserve. At long last, on August 15, 1971, US President Richard Nixon shut down the gold window, and the US reported to the world that it would no more trade gold for the US dollars that were held in foreign stores. This occasion denoted the end of Bretton Woods. Despite the fact that Bretton Woods didn't last, it cleared out an imperative legacy that still significantly affects today's universal financial atmosphere. This legacy exists as the three international offices made in the 1940s: the IMF, the International Bank for Reconstruction and Development, now part of the World Bank, and GATT, the forerunner to the World Trade Organization. Current exchange rates. After the Bretton Woods framework split, the world at long last acknowledged the utilization of coasting outside trade rates in the middle of the Jamaica Agreement of 1976. This implied the utilization of the highest quality level would be for all time annulled. In any case, this is not to say that administrations embraced an immaculate free gliding conversion scale framework. Most governments utilize one of the accompanying three conversion scale frameworks that are still operated today. First, dollarization, second, pegged rate, and third, managed floating rate. Dollarization. The occasion happens when a nation chooses not to issue its own currency and embraces a foreign coin as its national cash, in spite of the fact that dollarization for the most part empowers a nation to be seen as a steadier place for speculation. The downside is that the nation's national bank can no more print cash or make any kind of money-related arrangement. A case of dollarization is El Salvador's utilization of the US dollar. Pegged rates. Pegging happens when one nation specifically fixes its rate of exchange to a foreign coin, so that the nation will have fairly more soundness than a typical boy. Being more particular, pegging permits a nation's cash to be traded at a settled rate with a solitary or a particular bushel of remote monetary standards. The coin will just vary when the pegged monetary standards change. For instance, China pegged its yuan to the US dollar at a rate of 8.28 yuan to $1, somewhere around 1997 and July 21, 2005. The drawback to pegging would be that a coin's worth is weak before the pegged money's financial circumstance. For instance, if the US dollar analogies generously against every single other currency, the yuan would likewise acknowledge, which may not be what the Chinese National Bank needs. Managed floating rates. This sort of framework is made when cash's exchange rate is permitted to uninhibitedly change in value subject to the business sector strengths of supply and demand. In any case, the administration or national bank might intercede to settle amazing changes in return rates. For instance, if a nation's coin is devaluing far beyond a satisfactory level, the administration can raise transient financing costs. Raising rates should bring about the cash to acknowledge somewhat, yet comprehending this is an extremely rearranged case. National banks ordinarily utilize various devices to oversee coin. Market participants. Unlike the value market, where financial specialists regularly just exchange with institutional speculators, for example shared assets or other individual speculators, there are extra members that exchange on the Forex market for totally diverse reasons than those on the value market. In this way, it is critical to recognize and comprehend the capacities and inspirations of the primary players in the Forex market. Governments and central banks. A apparently, the absolute most compelling members included with cash trade are the national banks and governments. In many nations, the national bank is an augmentation of the administration and conducts its arrangement in tandem with the legislature. In any case, a few governments feel that a freer national bank would be more viable in adjusting the objectives of checking expansion and keeping financing costs low, which tends to increment monetary development. Despite the level of freedom that a national bank has, government delegates commonly have customary interviews with national bank agents to talk about the financial approach. In this manner, national banks and governments are typically in arrangement with regards to a financial arrangement. National banks are frequently included in controlling store volumes with a specific end goal to meet certain financial objectives. For instance, since the time that pegging its coin, the yuan, to the US dollar, China has been purchasing up a large number of dollars worth of US Treasury bills to keep the yuan at its objective conversion standard. National banks utilize the foreign trade business sector to change their store volumes. With amazingly profound takes, they yield noteworthy impact on the currency market. Banks and other financial institutions. In addition to national banks and governments, a portion of the biggest members included with Forex exchanges are banks. Most people who need foreign money for little-scale exchanges manage neighborhood banks. In any case, singular exchanges could not hope to compare to the volumes that are exchanged in the interbank market. The interbank business sector is the business sector through which vast banks transact with each other and decide the coin value that individual dealers see on their exchanging stages. These banks execute with each other on electronic expediting frameworks that are based upon credit. Just banks that have knowledge connections for each other can participate in exchanges. The bigger the bank, the more credit connections it has and the better the evaluating it can access for its clients. The smaller the bank, the fewer credit connections it has and the lower the priority it has on the evaluating scale. Banks, in general, go about as merchants, as in they are willing to purchase or offer a cash at the offer or ask cost. One way that banks profit on the Forex business sector is by trading money at a premium to the value they paid to acquire it. Since the Forex business sector is a decentralized business sector, it is normal to see distinctive banks with somewhat diverse trade rates for the same coin. Hedgers. A percentage of the greatest customers of these banks are organizations that deal with universal exchanges. Whether a business is offering to a universal customer or purchasing from a worldwide supplier, it should manage the instability of fluctuating monetary standards. On the off chance that there is one thing that administration and shareholders despise, it is a vulnerability. Dealing with foreign trade risk is a major issue for some multinationals. For instance, assume that a German organization arranges some hardware from a Japanese maker to be paid in yen 1 year from now. Since the exchange rate can vary uncontrollably over a whole year, German organization has no chance to get off knowing whether it will wind up paying more euros when the time comes to deliver. One decision that a business can make to diminish the vulnerability of foreign trade risk is to go into the spot market and make a prompt exchange for the foreign coin that they require. Unfortunately, organizations might not have enough money on hand to make spot exchanges or might not have any desire to hold huge measures of foreign coin for a longer time span. Thus, organizations most of the time utilizes supporting techniques, keeping in mind the end goal to secure a particular exchange rate for the future or to evacuate all wellsprings of conversion standard risks for that exchange. For instance, if a European organization needs to import steel from the US, it would need to pay in US dollars. For instance, the cost of the euro falls against the dollar before installment is made. The European organization will understand a budgetary misfortune. All things considered, it could go into an agreement that's secured in the present exchange rate to dispose of the risk of managing in US dollars. These agreements could be either forwards or future contracts. Speculators. Another class of business sector members, included with foreign trade-related exchanges, is speculators. Instead of hedging against movement in exchange rates or exchanging currency to finance international transactions, speculators try to make money by taking benefit of fluctuating exchange rate levels. The most well-known of all currency speculators is presumably George Soros. The billionaire prevaricates fund manager is most popular for speculating on the turn down of the British pound, a move that earned $1.1 billion within the time frame of a month. On the other hand, Nick Leeson, an imitative trader with England's Barings Bank, took tentative positions on future contracts in the yen that causes losses in amounting to more than $1.4 billion, which show the way to the fall down of the company. A portion of the biggest and most questionable speculators on the Forex business sector are multifaceted investments, which are basically unregulated assets that utilize eccentric venture methodologies with a specific end goal to harvest extensive returns. Consider them common assets on steroids. Hedge investments are the most loved whipping young men of numerous central bankers. Given that they can put down such gigantic wagers, they can majorly affect a nation's cash and economy. A few commentators rebuked speculative stock investments for the Asian cash emergency of the late 1990s. However, others have called attention to that the genuine issue was the idiocy of Asian national investors. Either way, speculators can have a major influence on the coin markets, especially enormous ones. Since you have an essential comprehension of the Forex market, its members and its history, you can proceed onward to a portion of the more propelled ideas that will bring you nearer to have the understanding of trading in this huge business sector. How Forex trading is done. You think you are prepared to exchange? Ensure you figure out how you can set up a Forex account with a goal that you can begin exchange currencies. This chapter likewise specifies different components that you need to know about before you make this stride. You will then examine how to do Forex trading and the distinctive sorts of orders that can be set. Opening a Forex brokerage account. Trading Forex is like the value market, since people intrigued by trade need to open up a trading account. Like the value advertise, each Forex account and the administrations it gives vary, so it is vital that you locate the right one. Leverage. Leverage is essentially the capacity to control a lot of capital, utilizing almost none of your own capital. The higher the leverage, the higher the level of risk. The measure of leverage on a record varies relying upon the record itself. Yet most utilize an element of no less than 50 to 1, with some being as high as 250 to 1. A leverage variable of 50 to 1 implies that for each dollar you have in your record, you control up to $50. For instance, if a dealer has $1,000 in his or her record, the merchant will loan that individual $50,000 to trade the business sector. This influence likewise makes your margin, or the sum you need to have in the record to exchange a specific sum. In values, the margin is ordinarily no less than half, while the leverage of 50 to 1 is proportional to 2%. Leverage is seen as a noteworthy advantage of Forex trading, as it permits you to make substantial additions with a little venture. In any case, leverage can likewise be a great negativity if a trade moves against you in light of the fact that your misfortunes additionally are opened up by the leverage. With this sort of leverage, there is the genuine plausibility that you can lose more than you contributed, even though most firms have defensive quits keeping a record from going negative. Thus, it is crucial that you recall this when opening a record, and that when you decide your desired leverage, you comprehend the risks included. Commissions and fees. Another significant advantage of Forex records is that exchanging within them is done on a free commission premise. This is not at all like value records, in which you pay the handler a charge for every exchange. The explanation behind this is you are managing directly with business sector producers and don't host to experience different gatherings like intermediaries. This might sound pipe dream, yet rest guarantees that market producers are profiting every time you trade. Every time an exchange is made, it is the business sector producers that catch the spread between these two. In this way, if the offer or request a foreign coin is 1,5200 to 50, the business sector producer catches the distinction, 50 premises focuses. For instance, that you are thinking of opening a Forex account, realize that every firm has diverse spreads on foreign cash, sets exchange through them. While they will frequently contrast by just a couple pips, 0.0001, this can be important on the off chance that you exchange a great deal after some time. So when opening an account, make a point to discover the pip spread that it has on foreign coin sets you are hoping to trade. Other factors. There are a considerable measure of the difference between each Forex firm and the accounts they offer, so it is essential to audit each before making a promise. Every organization will offer diverse levels of administrations and projects alongside expenses well beyond genuine exchanging costs. Additionally, because of the less managed nature of the Forex market, it is imperative to run a legitimate organization. How to trade Forex. Since you know some imperative variables to know about when opening a Forex account, we will now look into what precisely you can exchange inside of that account. The two principal approaches to exchange the foreign money business sector is the direct purchasing and offering of coin sets, where you go long one currency and shorter another. The second route is through the buying of subsidiaries that track the developments of a particular coin pair. Both of these methods are very like procedures in the values market. The most regular path is to just purchase and offer coin sets. Much similarly, most people purchase and offer stocks. For this situation, you trust the estimation of the pair itself, which changes in a great way. In the event that you go long a coin pair, you trust the estimation of the pair increments. For instance, suppose that you took a long position in the US dollars or Canadian dollars pair. You will profit if the estimation of this pair goes up and lose cash in the event in case it falls. This pair rises when the US dollar increments in quality against the Canadian dollar, so it is wagered on the US dollar. The other alternative is to utilize subsidiary items, for example choices and prospects, to benefit from changes in the estimation of monetary standards. In the event that you purchase an alternative on a cash pair, you are picking up the privilege to buy a money pair at a set rate before a set point in time. A prospect's contract, then again, makes the commitment to purchase the cash at a set point in time. Both of these exchanging systems are generally just utilized by more propelled traders. However, it is essential to, at any rate, be acquainted with them. Types of orders. A trader hoping to open another position will probably utilize either a market order or a limit order. The inclusion of these order types remains similar as when they are used in the equity markets. A market order provides a Forex trader the capability to acquire the currency at whatever exchange rate it is at present trading in the market, while a limit order permits the trader to denote a certain entry price. Forex traders who as of now hold a vacant position might need to think about utilizing as a take-profit order to secure a benefit. Say, for instance, that a trader is certain that the British pound or US dollar rate will achieve 1.7800, yet is not as beyond any doubt that the rate could go up any higher. A dealer could utilize a take-profit order, which would consequently close his or her position when the rate achieves 1.7800, securing their benefits. Another tool that can be utilized when traders hold open positions is the stop-loss order. This request permits dealers to decide how much the rate can go down before the position is shut and any further losses are collected. In this manner, if the British pound and US dollar rate starts to drop, a speculator can put a stop-loss order that will close the position, for instance at 1.7787, with a specific end goal to avoid any further losses. There are three ways through which corporations, institutions and companies do forex trading: spot market, forwards market and futures market. The forex trading in the spot market has always been the chief market because it is the basic real asset that the forwards and futures markets are based on. In the past, the futures market was the trendiest venue for traders as it was available to individual investors for a longer time span. However, with the introduction of electronic trading, the spot market has experienced a massive flow of activity and now outshines the futures market as the ideal trading market for individual investors as well as speculators. When someone refers to the future market, they are actually referring the spot market. The forwards and futures markets have a tendency to be accepted among companies that need to get around their foreign exchange risks out to an explicit date in the future. What is the spot market? To be specific, the spot market is where currency is purchased and sold according to the current price. Supply and demand determine the price, which is a reflection of a couple of things inclusive of current interest rates, economic performance, and response towards the ongoing political situation, both locally and internationally, along with the insight of the future performance of one currency adjacent to another. When a deal is settled, this is known as a spot deal. It is actually a two-sided transaction in which one party sends an agreed-upon currency amount to the counterparty and receives a particular amount of another currency at the agreed-upon exchange rate value. Once that position is closed, the settlement is in cash. Although the spot market is normally known as one that deals with dealings in the present rather than the future, these trades in reality take 2 days for settlement. What are the forwards and future markets? Forwards and future markets are not similar to the spot market, that is, they do not trade actual currencies. Instead, they deal in contracts that signify claims to a particular currency type, a definite price per unit and a potential date for settlement. In the futures market, futures contracts are purchased and sold based upon a standard size and settlement date on open wares markets, for example the Chicago Mercantile Exchange. In the US, the National Futures Association directs the futures market. Futures contracts have particular points of interest, including the quantity of units being exchanged, conveyance and settlement dates, and least value augments that can't be modified. The trade goes about as a partner to the merchant, giving leeway and settlement. Both sorts of agreements are fastening and are ordinarily settled for the trade-out inquiry upon expiry, despite the fact that agreements can likewise be purchased and sold before they terminate. The forwards and futures markets can offer assurance against danger when exchanging economic forms. Typically, huge universal companies utilize these business sectors with a specific end goal to fence against future exchange vacillations, yet terrorists join in these business sectors also. As you can see, the sort of requests that you can enter in your Forex trading account are like those found in value accounts. Having a decent comprehension of these requests is necessary before setting your first trade. Benefits and risks associated with Forex trading. Advantages linked with Forex trading. Cash Forex trading offers numerous interesting advantages in comparison to budgetary instruments. 24-hour market action. The Forex cash markets are a 24-hour commercial center beginning at 5 p.m. Eastern Standard Time Sunday to 5 p.m. Eastern Standard Time on Friday. This gives you the flexibility to trade Forex full-time or part-time at whatever time you find suitable and lifestyle allows. Liquidity. Being the biggest markets on the planet, the currency Forex markets offer brilliant liquidity at any hour of the exchanging day, not at all like numerous other 24-hour markets. This implies that you can exchange a lot of volume into and out of the Forex markets with insignificant business sector control. Leverage. Money Forex trading permits US members to leverage up to 50 times their account worth on most major Forex sets, while minor sets offer 20-to-1 edge. These leverage sums might change or may not be accessible at all times. For instance, with 50-to-1 influence, you might control 100,000 units of the euro cited at $1,300, utilizing just $2,600. Keep in mind that while leverage can fabricate benefits rapidly, it can likewise deliver vast calamitous losses rapidly. For global trade station customers, leverage measures of up to 400-to-1 are accessible over all cash sets. Trading opportunities. In spite of specialized training, the Forex markets offer one-of-kind chances to trade principal changes in economies all around the globe. Financial changes and improvements that one-in-one influence the coin sets are followed by a month-to-month timetable of occasion happening in significant nations around the globe. The greater part of the crucial advancements in the significant economies affects the business sectors in the middle of the arrival of information and drive longer-term patterns. Among the monetary pointers that influence the business sectors are GDP, job rates, and loan costs. Risks associated with Forex trading. Likewise, with all monetary exchanging instruments, there are risks you should consider before trading Forex. Leverage risk. Leverage is the system by which a merchant can control an extensive business sector position with a much littler beginning venture. For US customers, this empowers you to take positions of up to 50 times more prominent than the estimation of the underlying speculation for significant currency Forex sets. International customers can take upwards of 400 times the account's currency value. Nonetheless, proficient traders will frequently prescribe that your open Forex positions not surpass more than 10 times your aggregate account value at any one time. What's more, solid cash administration methods recommend not taking a chance with any more than 2 to 3% of your aggregate account value on any one trade. Despite when economic situations are moderately quiet, leverage can make substantial additions or losses rapidly. This might bring about your dealer to make a move to maintain a strategic distance from a negative record equalization, or to keep away from your account surpassing that most extreme permitted edge. In either case, your agent, without earlier warning, might close any or every single vacant position in the account to cure the circumstance. You are in charge of the risks you take and the outcomes of those perils, positive and negative, on each trade you make. In view of the much utilized risk characteristic in real money Forex, Forex trading may not be suitable for all traders. Price risk. Forex costs are quoted and charted and make use of just the current offer value stream. There is no perceptive of the last cost in Forex. Given that the value-based expense of trading Forex is attached to the bid-ask spread, it is essential to figure out what the usual offer advance spread is for any pair, and what that spread means in the authentic expense per exchange. The offer-ask spread can as well fluctuate all through the exchanging day and is repeatedly an element of the liquidity of the Forex pair. You might similarly see somewhat more widespread offer-ask spreads in peaceful business sector circumstances, chiefly on delicately exchanged Forex sets. As in any exchanging market, Forex costs are driven by short and long-haul supply and request, which make costs move rapidly and commonly whimsically. Traders need to utilize sound risk administration procedures on every last exchange. Utilizing stop-loss orders can hold back the most extreme introduction you will have in any given position. Interest rate risk. Generally, if a nation's financing costs rise, its money will regularly fortify in light of the fact that speculators will move their resources for that nation to increase higher returns. Alternately, if a nation's loan costs fall, its coin will regularly debilitate as financial specialists shift cash away searching for higher returns. Subsequently, if the interest rate differential of one currency compared to another one increases or decreases radically, the exchange rate and accordingly forex prices may also vividly change. News and economic risk. In the worldwide economy, news from any place on the planet can influence the forex markets from multiple points of view. These impacts can show as fast value developments or changes in pattern course or long-haul standpoint. It is thoughtful when trading either long-haul or short-term to watch out for news and different variables like government reports that can influence your productivity. Governments assemble monetary movement insights and discharge reports verging on consistently. The test is figuring out which reports might affect forex costs. The following is a short rundown of probably the most generally took after reports. Keep in mind that not all nations offer each report, and it is a smart thought to screen how certain reports influence forex currency before attempting to exchange in light of news and government reports. GDP. It is the total of all merchandise and administrations created in a nation by both domestic and foreign organizations. Expanding GDP shows a developing economy. Industrial production. It is the adjustment in the production or limit of the country's industrial facilities, mines and utilities. Increased productivity for the most part shows a developing economy. Consumer Price Index. CPI. It is a measure of the normal value level paid by purchasers. Expanding CPI might demonstrate a developing economy. Changes in CPI can likewise influence apparent loan costs. Non-farm payrolls. It is the number of new occupations made by the economy in the midst of the earlier month and the rate of labourers looking for business who stay unemployed. Expanding occupation for the most part shows a developing economy. Operational risk. Representatives face operational risks as they execute their everyday business exercises. Some of these perils emerge as inner strategies, HR, hierarchical structure, innovation, and so forth. In spite of the fact that they don't force a hazard to the business sector framework, all in all, they could keep you from observing positions or putting orders. Forex traders have to dependably keep up reinforcement systems in case that the internet or power comes up short.